Awesome. Thank you, sir. Thank you. And thanks everybody for being here. Honored to be with you today. How many we got on? About 36. Good number. Pretty good number. We've had 20, and I think we've had 120 maybe even. Really delighted and honored that you guys would invest a little bit of time with us today. Okay, let's get my share going. And oops, Jackson, I might need sharing privileges.
Did that work?
That worked. Beautiful. Thank you, sir. All right. So things have changed a little bit. Market shifting a little bit. Interest rates have changed just a skosh, just a little bit. So we're going to talk about that, you guys. We're going to talk about all of our regular major metrics. I always think it's important to do that. Buyer activity, seller activity, market times, inventory, you name it. But we're also going to look at a few other dynamics that are going on, including stuff like payments, cash sales, price reductions. So some stuff that we've seen before, but just of course updated with the latest numbers. And I do have some new content for you guys today. So I really hope you'll get a kick out of it, as much of a kick as I get out of it. The truth is, I could do this for myself and I'd be happy. All right, guys. I think I used this one last time, but I love it. It blows my mind. Here we are in 1937, and 3809 Longfellow's going for $3,400, $3,450. I did inflate that number, and with inflation, I think that would be like, was it 100 something K? So instead, we're at what, instead this house would probably be what, 380. Kind of interesting. We still can't control the wind, but we can adjust our sails. I know you guys are adjusting your sails as I talk right now. Hang on. Thought something looked funny. Let's try this one. Let's try this one, guys. All right. Sorry, that one was for a different audience. Okay. So they say that economists have predicted 17 of the last 3 recessions. I always find that to be extraordinarily amusing for a multitude of reasons. I think this one will be one. I don't think it'll be as dramatic as some think. And it's possible we're already, halfway through it, but it's possible it won't start until early next year or middle of next year as well. So nobody really knows what's going to happen exactly, but we know that the Fed is really tightening. They're really putting pressure on all corners of the economy. And we know how that ends historically. So we'll take a look at that. Guys, Warren Buffett says, Papa Buffett, best investor of all time, or one of the GOAT, he says, when you're in recession, it's really important to specialize in something, to be really good at something. I encourage you guys to become scholars of the market, to become students of the market, and really understand how the market reacts to changes in rates, changes in job growth, changes in unemployment, changes in household income, changes in household formation. How does price respond to inventory growth? How do market times change given different absorption rates, right? So, as the market is kind of doing this, it's going to soon do this, right? And be this guy or gal, right? Be this individual. So really do be thinking about, kind of leaning into the future and how to improve and open up opportunity down the road. All right, they say commercial real estate has changed, with remote work and remote learning, but I have found a strip mall that will always have a very strong demand, and it's this. I think I won. All right, as we sometimes say, you will feel a little bit like drinking from a fire hose. You will feel like this is information overload. As we always do, more than happy to share slides with you guys so you can spend a little bit more time with the content. Unless otherwise noted, everything's from North Star MLS and MAR. All the data is residential market activity, and it's the most recent data, unless otherwise noted. And remember, we do refresh history daily. Guys, if you were active 2 days ago and then under contract yesterday, but a contingency triggered and you fell through, well, now we've got to go back into history and say, let's take you out of pending and we got to add you back into inventory. So the numbers do move around. I know that can be confusing for folks, but just it's important to understand why. All right, folks, as we do, let's start with showing activity. Showings still one of the best leading indicators that we have for activity coming down the pipeline. What I can see still is that, current year levels are still hovering, noticeably below levels from the prior 3 years. And that's pretty clear. And, that's been a trend. One day it'll end, we just don't know when. I won't go over, the COVID in 2020 and then kind of strong in 2020 on the back half, strong in early first half of 2021. And then last year kind of got back on track with 19 in the second half. This year started off strong, right? In line with 2019 levels. And then as the Fed really started hiking rates, we saw showing activity decline, which of course was a leading indicator for signed purchase agreements to decline, which of course is a leading indicator for closed sales to decline, and so on and so forth. As we also say, the market is not an island. The market is not a monolithic thing. The market is an agglomeration of activity in different geographies, price points, property types, construction types, and styles, right? I used to say, it's like there is no, what's the national home price? Well, there is no national home price, right? It's like there is no national weather forecast. I don't grab an umbrella in Miami based on the weather forecast in Seattle. Oh God, I heard it as soon as I did it. I'm not going to talk about umbrellas in Florida. I don't grab an umbrella in Phoenix based on the forecast in Seattle. Let's use that analogy. Hearts and wishes still very much with our Florida friends and family. So guys, share of overall showing activity, you can see declines under 400K, minus a little increase here, not much. I call that pretty flat. A little bit surprised though, to see a little bit of an increase here. Declines, as soon as you get over 400K, this is where you see growth in the share of showings in each price point over 400K, especially our friends in million plus. I mean, if you kind of squint and turn your head a little bit, looks like this went from 1.8 to 3.6, right? So the share of million plus showings doubled, more or less, right? More or less doubled. Pretty incredible. All right, I can't remember if I shared this one last month. I don't think I did actually. So year-over-year change in showings, right, in the metro is a pretty noisy data set, kind of weather and, holidays and breaks and it's MEA weekend now. And so, not as many folks are going to go to showings tonight and tomorrow. And so take a look at our dotted trend line, you guys. I want you guys to note when showings were down 20%. Showings were down 20% in early April, right? That's when showings were down 20%. Now, how about pending sales? When were pending sales down about 20%? Oh, it was in June and July, just about 2 to 3 months after showings were down 20%. So I keep saying it, guys, and I'm going to keep, beating the horse and honking the horn. Showings are one of the best leading indicators of demand that we have. By the way, let me go back one. By the way, as we start to see this trend line curl up a bit, we're not seeing it yet, but we could, at some point next year, whenever the Fed pivots, right, this Fed pivot narrative, eventually we're going to see this curl. Nobody really knows the time frame. And as we do, we're going to notice it. We're going to share it with you guys, and you're going to know that as showings stabilize, so should sign contracts and pending sales and housing demand. So pretty fascinating. You can really draw a pretty close linkage there. All right, new listings. Let's take a look. September of every year since 2003. Down 17%, you guys. Down 17%. That is compared to 7,300, 7,900. Some might say we should compare to more like 7,000, kind of 2019, a normal, pre-COVID year, if you will. How about pendings? There's your 30% jump in pendings. There's your 30% drop in pendings, right? Guys, what if these 2 years were normal years, right? What if these 2 years were normal years and some of this demand was instead allocated here? Can you see that? Can you see how if we chop this bar off at say 5,200 or even 5,500, who cares, right? That extra 1,000, if we plop that down here, that would bring this to just about 5,000, right? So really what's happened is we've borrowed some demand, right, from this year, and it was brought into 2020 and 21. And the demand that would have occurred this year really has pulled back given what's happened to interest rates. Closing's pretty similar story, you guys. I won't go into too much depth. Right, pretty similar story. How about CDOM, cumulative days on market? Market times up almost 60%. It's just a week, right? Some sellers are really grateful for this. It gives them a time to, it gives them a little bit of time to get their house in order, quite literally. So 22 down to 15, down to 12, now back up to 19. So we're still below 2019 levels, but yes, above both of our COVID years. Still a far, far cry from, 80, 90, 100 days on market, right? 93 months, 31 month, we're still about half that. All right, how about median price? Latest September number. So we did show about a 6 1/3% increase in price to 362,000. Last couple Septembers showed 10%, even 11% increases, right? So, 6, 7, 11, 10, back down to 6 to 7. So you guys are going to notice that that's a pattern. Prices are not falling, right? Prices are not dropping. They're not in decline. It's hard to see them declining, in the near term. It's a little bit hard to see that. It's not to say it's not possible. But I do not believe they'll do that, at least for the rest of this year. Let's see what happens come spring market next year. And then you guys can kind of see compared to the bubble, into the crash and, the March higher, as we say. Okay, so even though you guys saw percentages here, the percent change, you also saw the number, the price level, right? Corresponding to our y-axis here. Now our axis is actually measuring percent. So it's measuring change. We're not looking at prices like we were before. We're looking at price change. Where to begin? Let's take a little walk down history, a little walk down memory lane here. Bubble years, 04, 05, 06, prices really only rising, 9, 8, 9, not even really 10%. I do find it really fascinating. So look at this, you guys. It was really all throughout 05, we started to see that rate of price growth slow. Now, I don't think many people would have interpreted that as impending doom, that this massive crash is coming. But, it's pretty clear that, things were kind of easing and softening a little bit. And this is before Countrywide or Lehman, before everything, Bear Stearns, all that fun stuff. Some of you remember the tax credit period where we had a little bit of stabilization. Some of you will also remember when we had a lot of investors and flippers descending on our market, paying cash and really shoving prices higher. And then most of you will also remember sort of the average times between 2014 and 2020, right? Those 5-6 years were, still a pretty strong market, but prices were growing. I suppose there were several 10% plus years, but on average, prices were growing 4 to 6, 5 to 7%, 4 to 8%. And then enter COVID. And then we had this COVID frenzy, and suddenly prices were growing at 10, 12, and 16%, right? So we didn't quite match these levels from, kind of phase one of this recovery, but we came close. And now look at what's happened, guys. Still above zero, right? Still positive, but the rate of growth is coming down. That's a good thing. That's healthy. That's sustainable, right? How many folks do you know whose incomes are rising at 16% year over year, 12% year over year? Boy, don't we all wish, right? Don't we all wish? This is to be expected when you have, market, when you have demand kind of moderating a little bit, and you don't have folks going, 20 grand over list price or more, or I should say 2, 3, 4, 5% over list. So keep watching this, guys. And, obviously we're going to keep tabs on this. We keep tabs on all the data and all the charts because that's what we do. But, it'll be interesting to see kind of where this flattens out. If it's 4, if it's 5, if it's 6. Do we touch, 8 one more time? Hard to say. Do we touch 1 or 2? Maybe. But I think this is really worth watching. And this is telling us a story that, the strength of the market has changed. Prices are not falling, but growth has softened, without a doubt. All right, so latest percent of original list price received at sale. So very simply, this is the ratio between asking price and sold price, or list price and sold price. So if I'm asking 400,000 and I accept 380, I just accepted 95%. If I'm asking 400,000 and I accepted 440, I've just accepted 110% of my original list price. Okay. Typical pattern we see throughout all of our data, strong in the bubble years, kind of weakening. Guys, here too, let me just pause on this. Look at 04, 05. You started to see weakness here. So again, I don't know that this was screaming we're going to have a housing recession and a mortgage bust. But in conjunction with prices and market times and other data points, I don't know. I was still getting my education in those years, so don't yell at me. But people should have spotted that. I don't know. Call me crazy. Anyway. So guys, we're down to 98.9%. So just about 99%. You'll notice that is higher than pre-COVID years. It's also still higher than bubble years, right? But yes, it is no longer over 100%. And yes, it is down from the last 2 years, right? That really were impacted by the COVID frenzy, the COVID buying, the buying spree. So still pretty strong, right? Sellers still getting about 99% of original, right? So before any price reduction. So it's pretty good. Inventory, active listings, homes for sale, right? Listings to write offers on, all the same thing. At one point in our fair metro here, we had 36,000 homes for sale, right? Before you get carried away and think that we need to be back there, we don't. That was a little bit of oversupply territory. We do need to be back at about 25,000, right? So we've got a lot of work to do. A couple thoughts there. One, it's going to take us a while to claw our way out of this deficit that we're in. Two, I think it's a good time for builders to continue to be adding to inventory, but they're not, and I understand why they're not. And then, three, until we get back to, and next slide will be better at this because it's month supply. But until we kind of get back to that balanced market of 4, 5, 6 months of supply, roughly, it's hard to see prices weaken. Not a guarantee, not financial advice, but it's difficult to see that. This time could be different, right? Easily, with everything else going on, with inflation being inflation being where it hasn't been in 40 years. So it could be different, but just kind of keep that in mind. And then last observation, guys. Yes, 1.5% increase. Yippee. If you want to celebrate that, that's okay. It's not much. What is it? 127 listings out of 9,000. So it's not much, guys. We call plus or minus a percent pretty flat. So I call that pretty flat. If your clients read in the media, we have, supply is up, supply levels are up. I don't want them getting this sense that, they have twice as many options as they did last year. They have 10 times as many homes that would suit their needs. They can go around and lowball people because we've got excess inventory, right? Because inventory's up. it's not quite like that, right? It's not quite like that. So, they might be seeing this or reading this, and then they're going to talk to you, and you guys get to sort of anchor those expectations and help them kind of get their head on straight. All right, so this is one that Jackson and I have been working on, and we've done some tweaks to it, and excited to share it with you guys today. While it's interesting and fascinating and somewhat exciting, it's also a little bit depressing, right? Not gonna lie, it's a little bit depressing. So this looks at the shortage. So in blue, we've got actual inventory by price point. And then in this kind of grayed out brick pattern color, I guess, we've got the shortage. And the shortage represents how much supply we'd need to get to 5 months of supply, right? And in this, let's see, what should we pick on? Yeah, well, let's do this one. From $250,000 up to 300K, we've got 1,000 homes on the market. We need 4,600, so we need 3,600 more, right? Or 325% more. Pretty astonishing. In million plus, we've got about 600. We only need about 70 or 80 to be balanced. And that's because that market has, I think, 4.6, 4.5 or 4.6 months of supply. So that makes sense. That passes smell test. 300 to 500, we've got about 3,800 of them. We need another 7,200 to be balanced. Overall, right? It's kind of how things look. So we got work to do. Now kind of broken out by single family versus townhouse versus condo. Pretty similar story, but you guys can kind of see the differences. Kind of interesting with townhomes. On a percentage basis, we need to increase townhome supply more than either single family or condo. And I think these have this kind of semi-detached feel where you're not stacked up in a condo tower. And people had concern, obviously, health issues and sharing, shared space and close proximity and sharing air and air filtration systems and everything like that. Jackson and I are city planners, and we believe in YIMBYism, right? And we believe in density as a way to address our affordability challenges and our supply challenges. And we know that's going to have to be part of the solution, whether you or we like it or not. But townhomes do offer this sort of little bit more affordable because they're shared common wall, right? A little bit cheaper per door to build, unless of course they're luxury. Not Grant Park. What's the one just where you get off the highway on 11th? Luxury townhomes there. And so, maybe not surprising that we see folks kind of thinking a little bit more about townhomes. All right, month supply. Promised you guys this one, from 10 months down to 1.9. Used to be a fairly balanced market, believe it or not, in 04, 05, either side of 5 months. Then we were oversupplied, right? This is a buyer's market. We're oversupplied. This is where buyers can write lowball offers and they might have some success, right? Fast forward to nowadays and still in a seller's market, actually still a pretty strong seller's market, but not to the same degree we saw last year, right? That's the difference. Not to the same degree. So month supply up 18.5% to 1.9 months, still sub 2 months of supply. But again, not quite as tight as it was, basically back to September of 2020 levels and still below 2017, 18 and 19 levels. All right, I know I show this one every time, so let's just speed through it. Every time there are some new folks on the call, so apologize if this is feeling a little bit stale, but want to show it nonetheless. Oops, my mistake, folks. Sellers markets, right? What do we mean? Well, this one seller has all the power. They've got 5 buyers all ready to write offers. Don't skip inspection. Careful with your appraisal gaps. No love letters, right? But they've all got pre-approval. They're all amped up, ready to go, and they're ready to outbid one another, right? And compete with one another. And the seller is just loving their position of strength. They're in a seller's market, right? They can name their price. They don't want to take that, loan. That's fine. This one's cash, but 2% lower. That's fine. This one's cash, but 5% over. You win. I don't even care about looking. They can be so selective. Oh, you want some fixes from the inspection? I don't think so. Oh, you want a home warranty? I don't think so. Oh, you wanted some seller paid closing costs? I don't think so. Not in this kind of climate, not in this environment. In a buyer's market, it's just the opposite. Instead of buyers competing to win over the seller, now it's the sellers that have to compete to win over the buyers. So it's kind of just the opposite. So here, sellers do have to offer home warranty, seller paid closing costs. Now we're seeing rate buy downs, right? Even though we're not technically in a buyer's market. But the affordability picture has changed so much that no surprise we're seeing some of that. And of course, seller paid closings and price reductions, right? Here's what we need, but it's hard to get. We want a balanced market. Supply and demand are pretty well matched up with one another. So here we are, folks. We got a standoff. Sellers think they're going to get offers over list like it's 2021, and buyers think they need to get a 2008 style good deal to make up for higher rates. It's a standoff, right? And nobody wants to move or blink first, besides that funny little girl there. Anyway, all right. Shall we, you guys? We've talked about this one a couple times. Let's see. What do we want to do? Yeah, let's do this one, guys. So in red, you've just got nominal home prices, right? This is the price that we paid at the time. In blue, you've got implied or inflation adjusted home prices using constant 2022 dollars. Now, of course, these are synced up now because in 2022, we're paying in 2022 dollars, right? That's the same thing. However, as you sort of interpolate backwards, look at what we would have paid for a home in 2005 if we paid in today's dollars. We would have paid over 350 grand, right? We would have spent over 350K, and now we're what? Well, depending on the month, 365, 375. So you guys can kind of see that. We actually spent 225, well, 235 back in that day, back in those days. And oops, apologies. Another way to look at this, guys, right? Two ways to look at this. Notice how red is the same. Red is nominal home prices, right? So red doesn't change, blue does. And this is in constant $2003. So this one, instead of seeing the gap back, darn it, this one's going to show the gap forward, right? So we start at the same place, and this is what nominal home prices have done, right? Paying in inflated dollars, but this is what real home prices have done, right? After stripping out inflation. So kind of two ways to look at it. Pretty fascinating. Speaking of inflation, should we pause and talk about this for just a second, guys? Why don't we do that? ISM, Institute for Supply Management, or Institute of Supply Managers, something like that. Survey back to 93, commodities reported in short supply and commodities reported up in price. All right. These things move in tandem, right? As we get a shortage of things, prices rise. It's just what markets do. So look at this increase of material or commodities in short supply, followed by a similar increase in commodities reported up in price. Now, you'll notice it's come down, hasn't it? Right? It's gotten better. It's still elevated, right? At, whatever, 10%, still elevated historically, but way off its highs, right? Way, way off its highs. Now, let's talk about the Fed and other discontents. Have you guys heard the quote, "Every general fights the last war"? It's true. Every general fights the last war. And they very often forget that there's a lag between action and reaction, right? And this includes our current battle against inflation. I don't know what it is, but there's something cool about these old generals. Maybe it's the facial hair or the outfits anyway. Now, let's help me think through a couple things. Lumber prices. When lumber was skyrocketing, right, in the beginning of 2020, right through 2021, the Fed saw no inflation, no evidence of inflation, no need to act. Now that it's gotten better, they're going to tighten us into recession. Seems reasonable. How about gas prices? Been rising for a while, right? 2021, even pre Russian invasion, right? And now illegal occupation. So, look at gas prices. Gas prices have been rising for a long time. Fed saw no inflation. Now that they've come down, minus the recent kind of OPEC news of cutting production, the OPEC plus, it's really an unfortunate decision. Now that it's coming down, right, the Fed is going to tighten us into recession. Perfect. Maritime shipping prices of shipping containers from Shanghai to LA. Prices up, right? Starting in, sure enough, COVID, beginning middle of 2020. Now that these shipping prices have come down, Fed sees a need to tighten us into recession. Sounds good, right? Fine, makes perfect sense. Home prices, right? Up for a while now, right? Especially accelerating at the, into second quarter of 2020. Now, as we saw, right, price growth is easing. Prices aren't down, but price growth is slowing. Now that it's slowing, Fed saw no inflation here, no need to do anything, no need to act. Now that it's kind of naturally resolving itself, Fed sees a need to tighten us into recession. I can't see anything going wrong here, right? Fair gain, right? Look at airfares climbing as the world opens to travel. So this one, I only found this going back to, I think this goes to maybe June or so. So I guess this hasn't come down yet, but it's just one, you guys. How about wheat prices, right? Wheat prices have been rising even pre-Russian invasion. The Fed saw no evidence of inflation here, but now that it's, getting better, the Fed has this need to tighten us into recession. There are several notable and intelligent individuals, and I'm not speaking about myself because I'm not sure I meet the criteria, but there are folks who really believe the Fed is making one of the biggest gaffes they've made. In their, how many decades, what 100-year was it? I don't want to say 19. Was it after World War I or after World War II? I can't remember, guys. I should know that. But that they're making, one of the biggest mistakes in their, in their almost century, in their multi-decade history. Let's see what happens. If they do push into recession, not to worry, we'll just lower rates. We're really only raising rates so that we can lower them in recession, next year. I don't know. That's not financial advice. That's not a guarantee, just a maybe. All right. Speaking of low rates, you guys will notice I had an important word change. I changed 2 letters and replaced them with 1. Can anyone guess what? All right. Put it in chat. Whoever gets this, I'll figure out something special to do. I'll give you a special chart. 2 letters became 1 letter. What are they? Okay, seeing no response, I will just tell you. I changed have to had. Historically low rates and rising incomes, they're not really anymore. So they had been partly offset the increase in prices. So guys, we saw before, compared to bubble levels, 06 into 2020, prices were here. Prices were way above bubble levels, right? But payments weren't. And that's because of interest rates. And then as interest rates stop being so friendly to us and to buyers, you guys can start to see what's happened to your typical PITI payment, your all-in monthly payment. Had to use some assumptions here, just so you guys know. 30-year fixed, assuming 10% down, a couple other assumptions. Did I miss one? No, I did not. Okay. Some of you are reading 50 or 60% increase in monthly payments. I've read that nationally. But, as I say, there is no national weather forecast. There is no, it's like saying, what's the average price of an item at a nationally for garage sales? I don't know. Sometimes it's $1, sometimes it's $5. Some people spend thousands on it, buying a used car to garage. I don't know. So, what I found is locally, or I should say regionally, we're more like 36%. So we're not quite 50. I'm not sure that would be encouraging news to someone, really desperate to buy a home, especially if they're earning less than the median income, right? That's not exactly positive, but it is less bad. I'll say that it is less bad. Not sure that's something to be celebrated, but who knows? Maybe it is these days. Anyway, So guys, this is June. This is your PITI payment for every June going back to 2016. Interesting here, 1630 down to 1616, right? As rates dropped with COVID. Started to climb a little bit, even though rates were friendly, right? Prices had really started to accelerate here. So we see that reflected in payments, but not a big deal, right? $200 a month, you're talking $2.5 grand a year. Not a huge deal. By the way, furnace, water heater, window breaks, dishwasher, what have you, a pipe bursts in winter if you don't shut off, you gotta turn the shut off and then drain it at the hose spigot. Anywho, if you have an issue, you're probably going to want to have an extra couple grand a year in wiggle room just in case something goes wrong, right? So that kind of thing happens. Now, from $1,800 to $2,500, that's $700 a month. That's $8,400. That's $8.5 grand a year. That's pretty substantial, right? That's pretty substantial. Now, listen, if your furnace and AC go out, that's $8 grand, right? That's depending on your model. That's 6, 7, 8, 9, could be 10 grand. You get the nicest carrier and train. I mean, I think you could be 10 plus. So it's not impossible that you'd have a $7,000 or $8,000 surprise cost as a homeowner. It's not impossible. A couple of years ago, someone was replacing their sewer lateral in Golden Valley. I don't know why Golden Valley has, you guys hear that Golden Valley has that? Why is that common in Golden Valley? Maybe they use like a special type of brass or drain tile or that clay tile, who knows? Anyway, guys, there are surprise costs when you're a homeowner, right? It happens. There's also a lot of equity gains, right? A lot, especially lately. So take the good with the necessary, something like that. So that's pretty substantial, you guys. $8,500 a year on the median priced home. That's a lot. But how about as a percentage of income? Let's take a look. All right, so back in 2006, we spent just under 25% of pre-tax income, right, on housing. Guys, we have to use pre-tax. Some people have short-term capital gains, long-term capital gains. Some people have trusts. Some people have multi-rental unit, income. So we kind of have to use pre-tax. You guys can see housing payments as a percentage of income actually went down, even though prices were rising. We spent a smaller share of income on housing, even though prices were up. Two things: incomes were also up, and rates were, so low and so friendly, so accommodative, I should say. So year to date so far, guys, I'm showing just about 26%, so slightly above that 25 mark. But get this, I'm still using the most recent income, which is a 2021 income. We don't have 2022 incomes yet. If I assume 3%, income growth, this figure is more like 25.25%. So, a little bit above bubble levels, but really not that much above bubble levels. Latest data from John Wake at RE Decoded, Real Estate Decoded. John does a great job. I love John and Mike Delpreet and a couple other guys really just do tremendous work. I absolutely have a data crush on those guys. So, kind of looking at the nation, kind of us here versus the nation. It is a good thing that prices did not rise here 20% plus. Instead, we only saw, 14% plus. Looks like we've really turned a corner. And by the way, guys, this is Case-Shiller. This is not MLS data. It's different. I'm really careful. I'm really careful about, again, our friends in Miami and Tampa. Want to be respectful of folks really struggling there. But those two Florida markets, you guys, you're talking 35% year over year price gains, 35%. That's like a $300,000 home, in Longfellow going for $400,000 next year. I mean, that's 33. Actually, it's 35%. That's more. Actually, looks like it could be 36 even. I mean, that's like a $300,000 home selling for $410,000 next year. That's insane. A $300,000 home in 2020 might have sold for $330,000, in 2021. But that's a different ball game. So you guys can kind of see how we're comparing, how we're faring versus some of our other regions. Great mean reversion. I know I've done this one before. I do update it, every time because it's 2022 year to date. So every month we get new data, or at least I try to. Let me make sure I do that this round. So you guys can kind of see, look at how things were looking heading into the bubble. As I say, there's our party, there's our hangover. Right? We had to give some of that. We had to give some of that back. Now, again, you guys, there's our channel. If we were growing at 5.5%, which is our long-term average growth rate, if we were growing at about 5.5%, we'd be right in the middle of this channel, right? Right in the middle of the channel. When we were over that channel, that should have been concerning, right? That was concerning. I was finishing up my master's degree, so again, please don't yell at me. Don't throw virtual tomatoes, please. So, where are we now? Well, we definitely see this slope has increased, right? Slope has accelerated. Is it time for a magnifying glass? Why not? Right? So slope here clearly has accelerated, but we're still only just kissing, just kind of flirting with that bottom end of the channel. So, this doesn't scream overvalued to me. This doesn't scream bubble to me, but it does say, we are kind of catching up to that long-term average. Now, let's see what happens with rates and affordability and incomes and the economy and job growth and everything else. I think it's fairly likely that we start to level off from here. I would say it's less likely that we start to do this, but I think it is likely that the growth rate will be at a lesser incline. That's my gut. Price reductions, one of your favorites. I'm also a fan. Just over 1 in 4, about 26.5%, 27% of listings required a price reduction to sell. So this is September data for every year going all the way back to 2003. I know some of you on the Zoom here will remember when 50% of the deals had a price reduction, right? 50%. Now, is this the trend, you guys? Help me understand this. Let's get a laser going. Well, better yet, let's get a pen going. Guys, is this the trend? Okay, is this the trend? No? How about that? Is that kind of the trend? I kind of think so. Right? So, people look at this. Well, people look at this and they think, oh, well, it's just going to be going down forever. And people look at this and they're like, oh, well, it's going to go up and hit 50, 60%, any minute now. And I think that's not the right way to kind of look at it. These were the exceptions to the norm, you guys. These were the anomalies. These were the outliers. This is a little bit more typical, as we can see, and remains well below, even 2003 levels before things really kind of started to inflate. Although, to be fair, they were on their way. So, not alarming. I think it is worth noting that this is at a 5-year high for September, right? August was not quite like that. And let's see, I hope you guys will come back next month and check out October with me, if I don't bore you to death today. So price reductions, pretty fascinating, pretty good insights there as well. Million plus, latest data. What's going on here? Golly, after that massive increase in 2020, we've held on to that, you guys. We've held on to all of it. We're still growing, growing slowly. So we're only adding a little bit, but we've held on to that spike, that surge. Wow. How about year to date? 500 down to 250-ish, up to 1,500, now about 1,100. All right, so I know I've said this before, but you guys be generous with me. Let's be charitable here. Squint and turn your head to the side, and let's imagine this is 750, and now turn your head to the other side, and let's imagine that's 1,500. So 750 to 1,500, million plus luxury market doubled in 2 years. We weren't able to hold on to all of those gains, but we did hold on to, I don't know about most, but a good chunk of them. Here again, you guys, let's do our trick again. Is this the trend? No? How about that? Is that our new trend? No? Okay. How about that? Is that kind of our long-term trend? That seems like it, right? Number one really seems like it, right? 2 and 3 just aren't really the trend, right? 1 is the trend. So this minus 19 looks extreme, right? But it's from an outlier, right? It's from an anomaly. This wasn't really the trend. All right, I'm going to have some fun here. Bear with me. Okay, enough of the fun. So guys, again, that's going to be a theme, right? We see this and, don't think it's doomsday all of a sudden. Let's remember what's the trend and what's an outlier. Because if you ask me, right, this trend is this. This trend is not this, and this trend is not this. All right, David, would you stop drawing on the slides already? All right, I had a little bit too much fun with that. Okay. Square footage, you guys. We got to keep moving. Not that long ago, right? People wanted bigger homes for entertaining, for living, for studying and working and everything, right? So look at the typical size or the median size of the home. It's come down a little bit, right? Again, this is not the trend. This is also not the trend. This is the trend, right? That's the trend. Average, I like to do median versus average. You guys can kind of see some differences. What was happening here? Remember condos? You guys remember that condo bubble, 09? Building a lot of condos. Condos are smaller. New construction, right? 15% down to 6, up to 12 or 13. Builders are pulling back, you guys, and I think that's unfortunate because as labor prices, lot prices, material and commodity prices are coming down, as we just kind of looked at not that long ago, I think it's a great opportunity for the builders to continue to try to claw our way out of the supply deficit, right? Out of this supply gap that we have that's plagued our market for a decade and a half, and will continue to plague our market for the foreseeable future because it's going to take so long to build our way out of it. So 13%, let's see what happens. We didn't quite get back here. Again, let's see what happens. 2021, we just couldn't find garage doors and appliances and shingles and siding, to an OSB board. I'll never forget at Home Depot, at Home Depot, a 4-foot by 4-foot sheet of OSB, half-inch thick. I don't even think it was the 3/4 inch. It was like $48. Aren't those like $8.99 or something? $50. It blew my mind. Unbelievable. Anyway, how about townhouse condo market share, guys? Look at how much it came down into COVID. Why? Everybody wanted single family. So of course, townhouse condo market share is going to be down. How about now? How interesting is this, guys? We see this townhouse condo market share on the rise because it's more affordable, right? Because it's more affordable. So actually, townhouse condo market share, wow, is at its highest level since 06. I bet some of you are going to be surprised by that. Now, YMMV, your mileage may vary. You may work almost exclusively in Rosemount and Farmington and Lakeville and Prior Lake, where you do, almost all single family, and that's okay. But it's just so fascinating to me. I don't know why I'm fascinated by it. I just am. But to see, folks all focusing on single family when we needed space, and now that we need some affordability help, not everybody, but we see that more folks are interested in this. I shouldn't call it multifamily, but this townhouse condo segment. Distressed market share, 50% of our deals used to be foreclosures or short sales. Now, 0.9%, right? Can't remember if I've told this story, but my uncle is a really good investor. He's really been a successful investor. Stocks, futures, commodities, you name it, foreign exchange. He's really good. He always says, David, stocks take the stairs up and the elevator down, right? We've seen that this year. Stocks take the stairs up and the elevator down. What does this do? Foreclosure kind of took the elevator up and then kind of the stairs down. I don't know why I find that funny, but I can't help it. All right, more beds, please. Percentage of all of our deals that had 4+ beds. Look at 2020. Look at that increase in 4 beds. 42% had 4 beds plus. How about recently? Down to 39. Guys, that's a 5-year low, right? People are looking at 3-bed homes instead of 4 or 5-bed as a way to get the price point down, which is a way to get their payments down, right? This is a monthly payment business. Is Todd Walker with us today? I don't think so. I don't think I saw him. Todd Walker has been saying that to me for better part of a decade. He says, David, this is a monthly payment business. Ask any lender. You go to any lender and they'll say, nobody asked me, nobody tells me price. They tell me the payments they want, and then I tell them the price. So that's kind of how it goes. 2,500 square, similar thing. We see an increase and then a decrease. Activity happening in Wisconsin. I would have thought we'd see an increase. We have not. Cash still rules everything around us. If you're able to get the money. 23% done in cash in 2011. How about now? Almost 15%. And here again, you guys forgive me, but how fascinating. Look at 10%. Why? How many first-time home buyers do you know with $380,000 cash in their account? I hope you know some, right? Most of them are probably, working tech jobs in the Bay Area. But, I know they're out there, but it's probably the exception and not the norm. So those folks couldn't pay cash. So only 10% did. Now, right, look at a 50% increase in cash market share from 10 to about 15 over 2 years. Now, folks are deploying their cash. Folks are using their cash so that they don't have to pay 7% interest. This still blows my mind every time I look at it. Million+ deals. 1 in 4 million+ deals are done in cash. 1 in 4. My God, power to you. Yeah, under 300K, not much of a difference here, kind of down and then up. So pretty similar. Thank you to our vets out there. DVA funding, never really exceeded 4.5. And it's come down. I've heard there's just so much demand and competition for it that it's hard. FHA loans now only making up about 7%. After the crash, they made up about 37%. Contract for you, let's skip. Time check. All right, only another couple minutes, guys. So let's look at change in closed sales real quick. City versus suburbs, right? So these follow each other pretty closely, kind of through market cycles, if you will. Looks like they're both way down given what's happened with rates, so not much of a change there. If you actually look, there's actually a greater increase in the city in sales, believe it or not, compared to the suburbs. Days on market, right? Pretty similar here. Look at this. Suburban market times way down because everybody was competing for more space, more room, more beds, bigger home offices. Now, days on market rising the most in the suburbs. Maybe because folks are looking for smaller, more affordable homes in the city, maybe. Change in inventory. We see just the opposite here, right? Suburban inventory actually on the rise while urban inventory actually falling. And that could be because of what we discussed. I'd want to look into that a little bit more, guys, but I'm just calling out the trend. Square footage, cities versus suburbs. Maybe you guys have wondered this, wonder no more. And the math couldn't be cleaner. It's roughly 2,000 versus 1,500. And honestly, that's about what I would have expected. So it's nice when it kind of works out. A little bit of condo activity here. So, 2,000 versus about 1,460, 1,450 square feet. What happens with interest rates and sales? Well, the opposite happens, as the title might indicate. When I zig, you zag. Guys, in blue is change in the 30-year rate. In orange is change in demand, change in sales. Rates up, sales down. Rates down, sales up. Rates up, sales down. Rates down during COVID, sales way up during COVID, and rates up during inflation and sales way down during the current inflationary period. Change in inventory, you guys, we are seeing growth on the coast and in the South in some of these hotter markets. We're just not really seeing much inventory growth here. And for that matter, most of the middle of the country. Blame our weather, blame whatever. Nice rhyme there, unintentional. But it's good. We're not seeing this increase in supply. Think about it. If we saw this increase in supply as demand is coming down because of rates, that's when you see prices weakening. That's when you see prices softening. And I do expect prices to soften in not all, but many of these markets that you guys have been reading about that have just been on fire. All right, looking at home prices moving forward, probably our last one here, guys. This year, 9.3, this is national. I think locally will probably be more like 7 or 8. And then you guys will see moving forward, you know, expect much more modest, more moderate price growth, you know, 3 to 5%. 3 to 5%. And then for 2022, you know, kind of look at the average, you know, here's your kind of 10% again. Fannie and Freddie always a little bit more optimistic, and our friends at the mortgage bankers always a little bit more bearish. But there you have it. I'll close on this one, you guys, from my friend and board member, Pat Paulson, shared this one with me. Here's me patiently waiting on home buyers to stop patiently waiting for the market to crash. You might need another cocktail or another adult beverage. I got a kick out of that. I'm patiently waiting on home buyers to stop patiently waiting for the market to crash, because it's probably not going to happen. And with that, I want to thank you all for coming. I know that was a lot. You'll get slides. Honored again that you guys invested a little bit of time with us today. Thank you. Thank you.
Well, thank you, David, and thank you everybody who stuck with us through the hour. Happy to have you as always. Please check your email early next week, where we'll be sending out a copy of these slides as well as a link for next month's housing market update. And we hope to see you then.
Thanks, guys. Thanks, Jackson.
Bye, everybody.